In 3 minutes, appreciation versus depreciation, the spice trick, 1 quick percent change calculation, and how firms dodge the damage. Let's go! An exchange rate is simply the price of one currency in another. If £1 equals €1.25, that's the rate. It appreciates when the pound buys more euros, depreciates when it buys fewer. Easy. Remember the mnemonic spiced: strong pound imports cheap, exports dear. Then simply reverse it for a weak pound. Exchange rates move for a variety of different reasons and can push the value of the pound either up or down on foreign exchange markets. Factors that often lead to the value of the pound going up include higher UK interest rates, lower inflation, confidence in the economy, strong exports, or investors seeking safe assets. Market nerves, lower interest rates, or weak growth can push it back down. Next, let's take a quick look at how to calculate exchange rate changes. For example, if the pound moves from £1 equals €1.20 to £1 equals €1.32, that's an appreciation of 10%. This means that UK buyers have 10% more spending power in the Eurozone than before. Importers love a strong pound, overseas inputs are cheaper, so cost of sales can fall. But will they cut prices or bank the profits? Depends on competition and strategy. What about exporters? Well, they prefer a weaker pound. UK goods look cheaper abroad, so volume can rise if demand is price-sensitive and rivals don't undercut. With a strong pound, exporters may need improved productivity, smarter pricing, or more local sourcing. Impact depends on 1. Price elasticity of demand. 2. The import content of your costs. 3. Contracts and hedging already in place. 4. Time lags, prices don't change overnight. Forward contracts can be used to lock in a rate, providing invoicing in sterling, and building in currency clauses, so you're less vulnerable to swings. 3 terms to drop into an essay: nominal rate is the sticker price, i.e. the price you actually pay. The real rate is the price adjusted for inflation differences. Lastly, the effective rate looks at the pound against a basket of trading partners. On to exam tips next. Define appreciation and depreciation, show a percent change calculation, apply to an importer-exporter, and evaluate with PED, cost base, rivals and hedging. Right, that's the lot. Just remember to visit teachingbusiness.org.uk for more great resources to support your teaching and learning of business.